this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, September 20th, 2024. As expected, the Federal Open Market Committee reduced its policy rate by 50 basis points this week. It also signaled that 2 more rate reductions are likely before this year is over and an additional 4 rate cuts in 2025. The policy statement accompanying that decision said that the committee has gained greater confidence that inflation is moving sustainably toward 2%, and judges that the risks to achieving its employment and inflation goals are roughly in balance. The FOMC also noted that it will continue reducing its holdings in Treasury securities and other federal agency debt. So here's a link to the statement in the body of the article, and I've highlighted here that first comment. So this is precisely the news that most folks on Wall Street were expecting. So there really was not that much of a reaction in the stock market Wednesday afternoon after that occurred. So what I'm going to do is I'm going to zoom in here to the S&P 500 and just really show you the last 3 months and then the last 5 days. And you'll see the 18th, which was 2 days ago, is the day that statement came out. There was a bit of a blip, an upward movement there shortly after that statement came out. But it gave all that back by the time the market closed at 4 o'clock, and actually it was down a little bit by then. However, the S&P 500 surged to a new all-time high yesterday, while the equal weight version of the index also hit a record high. So you can see here this big jump yesterday in the index. I don't know why it took Wall Street kind of a little while to react, but nevertheless, it did hit a new all-time high. So if we go back, say, year to date, you can see that yesterday just that little dotted line is above where it peaked back in July. So the equal weight version, which is an exchange traded fund that goes by the symbol RSP, you can see way over here on the far right, was doing already hit a record high before that, but that just helped it out a bit. So the reason why that's important is if Wall Street was afraid that the economy might be slipping back into recession as a result of the Fed's rate cut, it might have gone heavily back into those mega cap tech stocks that dominate the cap weighted version of the S&P 500. But the fact that the equal weight version also hit a record high means that's not the case. At the same time, the price of gold rose above $2,600 an ounce for the first time ever. Presumably, investors are no longer buying gold as an inflation hedge given the Fed's recent actions. However, China is buying gold as its economy weakens as a hedge against devaluation of its currency. Now, China is also concerned that economic sanctions imposed on it by the United States and its allies, if it takes military action against Taiwan, is also a motivating factor. And in fact, if you look at, say, the price of gold over the past 5 years, and remember Russia invaded Ukraine in the spring of 2022, the sanctions were imposed, but after bottoming out to below $1,700 an ounce in October 2022, gold is up substantially. And one school of thought is that China saw what was happening with Russia, the sanction imposed on Russia, and decided, hey, if the United States and its allies do that to us, then we want to have gold. And the reason why is gold is ubiquitous and can be more easily traded in the global commodity markets if China's financial assets held abroad are frozen or seized. Now, there's also the possibility that China is stockpiling gold in case Donald Trump wins the general election this fall. He has promised to reinstate import tariffs and other sanctions on China that could lessen demand for its products sold in the United States. If that happens, China might start selling its gold reserves to drive down the value of the dollar to reduce the cost of those tariffs. For all those reasons, do not read too much into the current direction of the price of gold. It is not indicative of future inflation, nor does it signal impending weakness of the dollar. It has become a political football that is getting kicked around the field until the outcome of this November's general election is known. Instead, think rationally and continue to look for relative value in the stock market. In my opinion, small cap stocks are one area that has been neglected by Wall Street while the Fed was raising interest rates. The small cap Russell 2000 index is no higher today than it was 3 years ago. So I'm going to show you now a chart of the Russell 2000, and I'm going to go back 5 years, and you'll see, that back here in the fall of 2021, the index was higher then than it is now. So 3 years later, despite the fact that large cap stocks have gone on to new heights and so on, small cap stocks are actually lower now than they were 3 years ago. So I'm reviewing small cap stocks and will soon be adding some to the PF Growth portfolio. I've been waiting for the Fed to start cutting rates, And now that it has, it is time to take action. That's this week's PF video update, and I look forward to talking to you in another week. Thank you.